This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Monday, July the 9th, 2012. I'm Gord Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly and leave you to examine them further at your leisure. You will need to open your slide viewer to full screen viewing, or you'll simply not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our monthly cycle as outlined on the subscriptions page on our site. In this regard, though, I want to talk today about the cold plunge in profits that lies ahead. Specifically, I want to talk about earnings, the upcoming Q2 earnings season, which kicks off today, the U.S. economy and what we're seeing there, and PE compressions that we've talked about previously, and to talk a little bit more on what we're currently seeing unfolding during the earnings warning season. The quarterly drop in U.S. corporate profits from abroad in the first 3 months of 2012 was $48.1 billion. It's finally becoming increasingly clear that what happens overseas isn't likely to stay overseas. We have been warning of this in these audios since early Q1 when this was occurring but not being reported. The final data for gross domestic product was released just over a week ago, showing that the economy grew at an unrevised rate of 1.9% in the first quarter. Markets basically yawned as they went back and focused on the Eurozone summit and the release shortly thereafter of the Supreme Court's health law, Obamacare decision. But beneath the unchanged headline numbers were some very worrying new details and confirmations. For one, corporate profits were revised lower. The new data showed the first quarterly drop in the measure since the darkest days of the recession in the fourth quarter of 2008. At first glance, the drop in profits was a bit hard to square with the job numbers for the first quarter. Sure, unemployment has been weak for the past few months, but it was strong in the early part of the year. The answer came in where the profits drop originated. Profits from the U.S. were actually strong in the first quarter, jumping about 10% from a year earlier, but earnings coming from the rest of the world tumbled 12% from the first quarter of 2011. Meanwhile, export growth was revised down to just 4.2% gain from previously reported 7.2% increase. Weaker corporate profits from abroad and slower export growth are telling a clearer story of a global slowdown. But the worrying part is that the story is already 3 months old. The second quarter was even worse for the global economy than the first. That helps explain some of the weaker data in the U.S. in the past few months. For a while, it appeared that the problems overseas weren't spreading too badly to the U.S., but the revised data makes it clear that the spillover was already starting earlier in the year, and we were very, very clear on that. The drag was likely exacerbated in the quarter that just ended. Hopes are, as expected, now languishing that Europe, in fact, has gotten its act together following the recent summit, the 12th consecutive summit with little to nothing to show for it. We continue to see plans that are long in statements of unity and promises for future actions, but frankly short on specifics. What we see is that in the first quarter, the U.S. stayed mostly healthy, while the rest of the world came down with the flu. In the second quarter, it looks like America caught the bug. As the third quarter begins, it still isn't clear whether we spend the summer recuperating on the beach or in bed with pneumonia. Expectations for revenue for the coming 52-week period have dropped slightly since early May for companies in the S&P 500. They had been rising steadily since November. Analysts have likely trimmed expectations due to troubles in Europe, which makes up about 22% of these companies' revenues. Even without a major global slowdown, the typical high sales growth period following a recession is over. Sales for companies in the S&P 500 rose at 6.5% in the first quarter, the slowest pace since they began expanding again in late 2009. The average of the preceding 8 quarters has been a heady 10.7%. Now expectations for the coming 12-month period are down to 4.7%, according at least to data from Thomson Reuters. Though that seems low, it actually may be a tad optimistic. Corporate sales correlate highly with nominal economic growth, which isn't adjusted for inflation. Nominal growth is seen around 4% in 2012 and 2013 in the U.S., while Europe should be weaker. If analysts are behind the curve in trimming sales growth expectations, it wouldn't be the first time. On the eve of the Lehman Brothers collapse, and amid an as yet undeclared recession, year-ahead sales expectations were at an all-time high. By the following spring, they had slipped sharply and were too pessimistic. Even if we are merely in a slow patch, look out below for expectations of revenue growth. The front and center worry on analysts' mind is actually the strength of the U.S. dollar, in my opinion. The weakness in the euro and the flight to safety of the U.S. dollar means an earnings impact for U.S. corporations reporting in U.S. dollars. Though corporations use forward contracts extensively and various other currency hedging techniques, this will no doubt weigh heavily on the markets. And I'm going to talk more about that as we go. Strong indications of dramatic economic slowing and earnings impact have been surfacing for a number of weeks now. One of the oldest economic tricks in the books is to follow the level of FedEx package shipments as a barometer of overall economic conditions. There is a strong correlation between shipments and the pace of real GDP. The latest announcement from the shipping giant suggests a weaker economy ahead. During its fourth quarter 2012 earnings conference call, which was ending May 31st, average daily volume of total U.S. package shipments at FedEx Express services were 2.49 million, 4.9% lower than year-ago levels. U.S. package shipments have been steadily falling on a year-over-year basis and are now negative 5% year-over-year. This was the 5th consecutive quarterly decline on a year-over-year basis. FedEx's economic forecast calls for calendar year 2012 U.S. GDP growth to be 2.2%, with an associated 4.3% increase in industrial production. A key metric for the shipping trucking industry. For calendar year 2013, GDP is expected to advance by 2.4%. According to the company, the assumption of these forecasts are: 1, successful management of the debt crisis in Europe. I'm skeptical of that. And 2, the avoidance of significant tax increases next year in the U.S. I'm also very skeptical of that. Alan Grafs, the FedEx Executive Vice President and Chief Financial Officer, said the company believes domestic and global economic conditions will be impacted by, and I quote the list: 1, the European debt crisis; 2, slowing growth in Asia; and 3, the uncertainty both these issues are creating. I'm skeptical of any resolution to these. Let me give you some more high-profile examples, if I could. Philip Morris. Tobacco powerhouse Philip Morris International is just one of a growing number of companies in the Standard & Poor's 500 index who've already cut earnings guidance to reflect the impact of stronger U.S. dollar. It is also warned that it is seeing sales of tobacco and cigarette products drop in the European markets. So we have the two issues working together. A quote from Bob McDonald, the company's chairman and CEO at a recent Deutsche Bank Global Consumer Conference was, and I quote, "Growth in developed markets has dropped off significantly. These markets still account for 60% of sales and even greater percentage of profit." It doesn't help that the company noted that commodity costs also have risen sharply, by the way. End of quote on that one. Merck. Pharmaceutical heavyweight Merck sees the same trends buffeting its own earnings. And another quote here, this one from Peter Kellogg, Chief Financial Officer of Merck, during the company's first quarter conference call with investors and analysts, though this was back in April. Quote, "At today's exchange rate, sales in second quarter would be adversely affected by at least 3%. So we can expect that as a at minimum kind of guideline across the board, or at least a frame of reference. Procter & Gamble and Pepsi, another example, in the final days of second quarter, like other big multinational companies, are giving negative guidance for their second quarter results. And let me show you a chart I pulled from Procter & Gamble's conference call. This slide I felt was very telling. It differentiates organic growth between developed markets and developing markets. The developed economies are clearly facing problems that are more than a cyclical business cycle, even though we could say the cycle's turned down. These are longer term. They're structural in nature. This chart, to me, speaks not only of the upcoming earnings season, which, as I said earlier, kicks off this week, but future earnings seasons. Procter & Gamble is an excellent global bellwether. I mean, its brands cover a broad range, probably the largest in the consumer market, and certainly around the world. And its messages should be, to me, taken very serious. And this is an alarming chart. The S&P companies have been steadily achieving larger and larger levels of profit and growth from outside the U.S. I don't think that's any surprise to anybody. This chart shows S&P sales in Europe as a percentage of total revenue. The economy across Europe is in what can only best be described as free fall, based on the recent PMI results. Economies across the board, including Germany, are now in contraction, not slowing, just contraction. And I'll talk more about this in a few moments. The strong dollar simply exacerbates the impact of economic weakness worldwide, particularly in Europe. The combination isn't a good sign for the upcoming Q2 earnings season. This chart provides a selection of companies in the S&P 500 that actually break out their sales by geography and have the greatest exposure to Europe, as calculated as a percentage of their total revenue, which, with that revenue translated in this chart into British pounds, it's the best I've seen. And, it's amazing how poorly global revenues are broken apart and reported publicly by global corporations, and the dearth of roll-up analysis that's available. From among these companies, Coca-Cola Enterprises generates the highest percentage of sales, 66% shown here, from Europe, meaning that its second quarter earnings are very likely to take a hit. Not surprising, all 11 analysts covering the stock who have changed their estimates, have lowered their earnings per share estimates for the quarter. The dollar impact? Well, Bill Douglas, the company's chief financial officer, told a Deutsche Bank Global Consumer Conference that he expects currency translation, and again I quote, to have a negative high single-digit impact on earnings for 2012 as a whole. My translation, close to 9%. If you could couple shrinking profits due to euro-US dollar exchange hits along with smaller absolute volumes, you have a recipe for earnings disappointment. However, you can be assured these are being quickly baked into expectations for this upcoming reporting season. Pay close attention to why CEOs think it is going to be better in Q3 and Q4. Don't be fooled by the earnings beat numbers that CNBS will throw, no doubt, naively around throughout the season. There is an old adage that you can't and won't have a strong stock market without strong bank stock performance. Troubles in banking stocks are a sure indicator of potential problems for the overall stock market. And there's a series of reasons of why that is the case that I won't get into here. So let's look at the global bank stocks for a moment. Bank investors prize return on equity as a measure of how well a financial institution uses its capital to generate profits. But industry-wide, even though return on equity is down, it is still at levels before the great reflation of 2002 to 2007 that were thought unimaginable. Is the right approach taking on more risk or going back to basics? Large global financial institutions could routinely earn return on equity for their shareholders north of 10%, and often even above 20%. The financial crisis of 2008 brought about a host of new regulations and restrictions on their activities, such as the provision of the Dodd-Frank Act, barring much or a considerable amount of proprietary trading and many investments in hedge funds and private equity vehicles. The more capital they need to keep on their balance sheets and the more higher risk but potentially profitable business they can no longer pursue as actively, the greater the potential for the return on equity to dip. The common worry has become that if their return on equity fell below 10%, investors would be less willing to purchase their stock, since at that level the returns were less attractive relative to the risk and the degree of volatility in the share prices. A return on equity of around 20% enabled a bank stock to trade at around 3 times book value. A smaller return on equity would weigh on that book value ratio and thus the share price. As return on equity levels have declined since the financial crisis, so too has the book value of banking stocks in both the United States and Europe. European banks in particular appear to have a lot to worry about, with price to book ratio on average of around 0.5. However, when a company trade at a level below its book value, it signals that it is generating return on shareholders' equity that is below its cost of capital. Thus, instead of creating value for shareholders, it is actually destroying it. In theory, although it's rarely practiced in the real world, it would be better for the directors of such a bank to liquidate if they weren't able to return that return on equity around and boost the book value. Obviously, that never happens because things are going to get better in the morning. Maybe not the case here for a protracted period of time, and possibly banks may be at a major long-term cost. I wouldn't invest on that yet, but it is certainly something to pay a lot of attention to. The quest for return on equity sets the recent headlines involving both Barclays PLC and JP Morgan Chase in an interesting context. I bridge that to my comment about maybe this is at a long-term cusp for banking stocks that we're at. And, at both banks, traders violated either the law or the bank's internal policies and ended up costing their institutions both money and maybe even more importantly, reputation, credibility. And that's the most important thing banks have, is credibility, or at least had before. At Barclays, let's be specific here. At Barclays, bank employees were involved in a scheme to rig the interbank lending market, LIBOR, by accommodating favored clients at special rates. The result so far, and it's getting more serious by the way, is a $450 million fine that included the largest ever levied by the Financial Services Authority in Britain, and the exit of the chairman, the CEO, Bob Diamond, and the chief operating officer. To me, this reminds me of Bear Stearns, Lehman, Merrill Lynch, and Citi during that September 2008 financial crisis, where not only were people resigning, they resigned abruptly, and it made you question what was going on behind the curtain. I personally believe this is a monumental development, and I'm speaking here to the LIBOR scandal, that is currently just barely scraping the surface of a $500 trillion swap market, interest rate swaps, which has profound impact. Pay keen attention to this story, because other banks are no doubt will be dragged into it if the authorities can't cover this whole thing up. It is going to be bad news no matter what for the banks. Now, let's go to talk about J.P. Morgan. Life for Jamie Dimon as CEO isn't any more rosy these days. Since the bank disclosed this spring that a London-based trader had accumulated a position in a complex web of credit derivatives that has so far generated a $2 billion loss, and I see reports where it's going to be minimally north of $9 billion, but they're unsubstantiated as of yet. Diamond has been left with egg on his face, and after years of insisting that banks could do the job of regulating themselves, and he was a prime spokesman for this, he is now focused on preserving the bank's return on equity as much as possible, along with his credibility personally, and the bank's credibility. There's no evidence that he himself turned a blind eye to the trader's activities, hoping for a big win instead of a big loss. But the risk management failure draws attention to what can happen within a financial institution that is trying to get back to generating the kind of return on equity it once did, and I outlined here for investors. And Diamond certainly seems to have moved very rapidly to get the trade off its books, as I saw in a Reuters Breaking View article that noted that their analysts calculated that as much as 70% of the trade may have been unwound thus far, despite the fact that Diamond had earlier sought to reassure investors he would try to maximize economic value and could hold on to some of the assets until later in the year, if need be. Now it seems as if Diamond has acted precipitatively, especially if last week's media reports that the size of that loss may reach $8 billion or more prove to be accurate. Currently, the mean estimate by analysts for J.P. Morgan Chase return on equity for the current year stands at about 9.45%. The StarMine Smart estimate, however, which places a greater weight on the most recent forecast by those analysts with the most accurate track records, is slightly lower at 9.38%. At Barclays, for 2012 return on equity, the estimates are 6.36%, is slightly higher than the mean forecast of 6.28%. Even the mightiest Wall Street firms are struggling to post a return on equity that once would have been considered, as I said before, barely acceptable. At Goldman Sachs, for instance, where traders and bankers once deployed the firm's capital so effectively that return on equities rose from the teens to north of 20%. The mean estimate forecasts 2012 return on equity of only 8.8%, while Smart estimate is a notch lower at 8.6%, and J.P. Morgan Chase and Goldman Sachs are far from being the worst off by a long stretch. Among the money-centered banks that can be viewed as J.P. Morgan's peers, Citigroup has a Smart estimate calling for an ROE to hit 6.63%. Bank of America's may earn an astonishing low return of 2.84% this year. Ironically, after so many years in which taking big risks on trading desks or taking proprietary positions in highly leveraged deals with a ticket to a higher return on equity for most financial institutions, these days it is more plain vanilla institutions that can lay claim to being able to generate higher returns on equities. Wells Fargo, the biggest bank The one that has the least exposure to trading or investment banking is the standout performer. The analyst's mean forecast is that it will generate 12.74% return on equity this year, while smart estimates suggest a figure closer to 12.42%. That's still double the rate at which Citigroup or Barclays will generate profits on their own sizable balance sheet. Indeed, Berkshire Hathaway's Warren Buffett's favorite stock, Wells Fargo, or at least one of his favorites, a major holding, is one financial institution that appears to be emerging from the financial crisis in a position of relative strength. After it downgraded the debt rating of 15 banks last week, Moody's Investors Service this week affirmed its ratings on Wells Fargo. I'm not recommending Wells Fargo, but I'm just trying to say that, there are some banks that took different strategies that are paying off and holding up a little better right now, but they're all going to be tarnished with the same brush. It is unlikely that any of these financial institutions will abandon the pursuit of maximizing return on equity anytime in the near future. This remains a metric by which investors can judge how skillfully the managers of the banks in which they invest are deploying capital. The trend is clear, not well. What recent trends and news events seem to suggest, however, is that the kinds of activities that once contributed to that return on equity may, in the new market and regulatory climate, be less rewarding. As go the banks, so go the equity markets. Last Friday's labor report was, I think it's an understatement, a major disappointment for the market. 90 of 90 analysts got it wrong, and I mean badly wrong. This chart shows there is a very strong correlation between the initial jobless claims, that's not the labor report, but the initial jobless claims comes out every Thursday, and the S&P 500. If initial jobless claims begin to trend higher, the market will be in serious problems, regardless of historical presidential election year trend cycles. And I'm watching these very closely because this could put a monkey wrench into some of our forecasts right now. I need to really stress this here. Further deterioration in the labor market will cost, in my opinion, Obama the election and the market's late Q3, early Q4 rally. Another strong correlation to watch is the relationship between the S&P 500 and the various manufacturing reports. Shown here on the left is a correlation between the S&P 500 and forward earnings estimates on a year-over-year basis. No real surprise, I'm sure to many. On the right, we have the correlation between earning estimates and the ISM corporate PMI survey. We see here not only the correlation, but the ISM leads the earnings estimates and the revisions. Again, no real surprise other than everything is so strongly trending lower. This chart shows that the Empire and Philadelphia Fed survey correlate with the ISM report and in turn lead the ISM quite nicely. Not only are the most recently released Empire and Philly Fed numbers down and down hard, but they are now below 50 and in contrarian territory. There is little doubt earnings are coming down and down significantly. As I said before, Q2 can be expected to be massaged and window dressed to beat reduced estimates. The question is how much has been and will be taken down from Q3 and Q4 guidance. What is alarming here in the charts is the rate at which the slowing is actually occurring. Not just that it's occurring, but the rate. If you get inside these numbers, from the overall PMI being down 3.8% in 1 month to new orders down 12.3% in the same month, to production, to inventories, to prices, to backlog, to exports, it's clearly a broad-based slowdown. This tells me it's not simply a bad month, but rather a strong indication of a major change in trend, a pivot point, if you would. Factory orders shown here indicate a very clear trend. Even defense and transportation don't appear to be able to save the day as they often do with large spikes. Despite channel stuffing by General Motors, who, by the way, now face a class action suit on the matter, and something I was warning about in our audio discussions on the fallacy of the U.S. GDP reporting, vehicle sales are trending lower. This is not just a GM. Peugeot in Europe just hit the news wires with devastatingly bad numbers and may not in fact survive without yet another European bailout, this time in the industrial sector. The ECRI's weekly leading index has now gone negative with a negative 3.0 reading. I have drawn 3 red circles on this graph to show the reading and trend of the WLI as it entered previous recessions and where it is currently. It is quickly approaching a signal that we are in a recession. We are presently only a hair away. Remember, it will be the end of Q1 2013 at the earliest before this will be could be made official. 2 consecutive negative quarters. No one chart or metric is infallible, but when the preponderance of evidence is all telling the same story, you should be able to draw conclusions. I did the same thing in this chart of year-over-year real consumption expenditure percentages. You'll note the vertical recession bars and the small red circles I've drawn in, a completely different metric with the same message. The U.S. is very close to entering into a recession. The Fed is well aware of this, and Bernanke has been extremely clear that QE3 will be launched if growth slows or does not materialize. Hello. Obviously, he is and was setting the stage for something that he knew was in the cards, or the probability was very high, something we saw very clearly in late December and early January. It all sounds like, to me, an August FOMC announcement. Expect the markets to smell this and begin pricing it in. About 500 to 700 billion in size is what I see personally for the QE3 to come in some manner. That's another discussion, which we won't go into today. This chart of the year-over-year real GDP versus the Michigan sentiment shows a very large gap or divergence. This divergence is unusual and suggests it will soon be resolved. My guess it will be with falling real GDP, which Bernanke will use as cover for QE3. Here is yet another chart with vertical recession bars plotted. Dining out typically plummets hard as a precursor to a recession, and you can see this on 2 previous occasions. That has not occurred yet, but certainly appears to have hit an upper channel from which a fall off would be expected. This chart from a Smucker's client presentation I saw suggested it is likely to soon show itself in the restaurant reporting results. This is where they get their goods. A final chart before we switch gears is something called the Chemical Activity Barometer chart. I'm sure you've never seen it or heard of it, but when I dig through the details, these are the kinds of things that give you clear visibility. The American Chemistry Council's chief economist, Kevin Swift, created this Chemical Activity Barometer, which tracks chemical production, prices, hours worked as producers, and manufacturing output, among other factors. This indicator, based on its visibility and integration into the supply chain, and this is important, it's inside the supply chain, and it provides a signal that the outlook for the economy is slowing during the next 6 to 9 months, since 96% of manufacturing goods are derived in part from materials produced by the U.S. chemical industry. 3-month declines of 3% or more have preceded all but one recession since 1947, and it is currently down 2.5% from its highs in March, suggesting subpar growth is coming. I don't think anything more needs to be said here. Bernanke has a gun to his head to react in some form, some manner, and the clock is getting near here. The following 3 charts from UBS also suggest that things are not quite as rosy as one might believe. Between 1, consensus growth expectations rolling over. 2, the analysts downgrade ratio turning negative once again. And 3, recent changes in U.S. growth remaining positively ecstatic relative to global regional changes. It would appear hope is a powerful and hallucinatory drug, as is QE, quantitative easing Kool-Aid. The progression of consensus earning growth estimates is rolling over for 2012 and stalling for 2013. The upgrade-downgrade ratio shown on the left is turning back down, less upgrades and downgrades, and changing trend. On the right, the U.S. remains an extremely optimistic, unchanged over the past 3 months for its earnings growth forecast change relative to considerable drop among most of the world's economies. This chart illustrates how the recent rise in earnings as well as recent decline in stock prices has impacted the current valuation of the stock market as measured by price to earnings ratio, PE ratio. Generally speaking, when the PE ratio is high, stocks are considered expensive. When PE ratios is low, stocks are considered to be inexpensive. From 1900 into the mid-1990s, the PE ratio tended to peak in the low to mid-20s, the upper red line, and trough somewhere around 7, the lower green line. The price investors were willing to pay for dollars of earnings increased during the dot-com boom in the late 1990s, surging even higher during the dot-com bust early 2000 and spiked to extraordinary levels during the financial crisis in the late 2000s. With the exception of a brief period in late 2011, the PE ratio is currently at levels not seen since 1990. The question is, where is support for the PE ratios? PE ratios expand when earnings growth outstrip the rate of revenue growth. Conversely, when earnings fall faster than the growth rate, then PEs contract. Expectations for slowing overall rates also compress PE ratios. PE ratios in the 10 to 11 range or lower are likely going forward. This chart supports the view of PEs in the 10 to 11 range or lower. The question is when. This chart is yet another way of considering the time frame and rate of the change. Late 2012 and 2013 seems highly probable, especially if the global economy does enter into even a mild recession. The broad theme of buying stocks because they are cheap, as evidenced by the dividend yields premium to U.S. Treasury yields, seems to fall apart a little once one looks at a long-run history of the behavior of these two apples to unicorns yield indications. Forget the risky versus risk-free comparisons. Forget the huge mismatch in mark-to-market volatility, and forget the huge differences in max drawdowns. Prior to World War II, the average S&P 500 dividend yield was 136 basis points over the 10-year yield, and while today's equity valuations is the cheapest since the 1950s, relative to Bernanke's zero interest rate policy, ZIRP-driven bond market, the old normal suggests that this time is no different at all and merely a reversion to the more conservative times, leaving stocks far from cheap. Earnings pre-announcements paint a less than rosy picture of what lies ahead. Companies in the S&P have issued 26 positive earnings per share pre-announcements, but that has been dwarfed by 93 pre-announcements cautioning that these companies might not live up to analysts' expectations for second quarter earnings. To compute a ratio between these negative and positive pre-announcements, an NP ratio, you need to only divide 93 by 26. The answer, 3.6, is the weakest showing in more than a decade, specifically since the third quarter of 2001. The information technology, consumer discretionary, and healthcare sectors have seen the largest number of negative earnings pre-announcements. In addition to the unfavorable exchange rates, companies are citing slower economic growth in emerging markets and Europe as one of the many problems that corporate America must grapple with. Analysts' downgrade revisions, coupled with negative guidance from the companies themselves, makes corporate earnings look bearish in the second quarter. As a result, estimated growth rate for earnings by companies in the S&P 500 has actually fallen from 9.2% to 6.1% since the second quarter began in April. If the expected earnings growth rate comes in at 6.1%, and that's a big if, it will be the third quarter in a row in which earnings growth has remained stuck in the single digits after 8 consecutive quarters of double-digit growth. Excluding Bank of America, the estimated growth rate for the S&P 500 drops to 1.1%. It doesn't help that those companies that are generating growth in sales are still having difficulties converting that into growth on the bottom line. According to Thomson Reuters IBES data, 9 of the 10 sectors in the S&P 500 will record higher revenues for the second quarter, but only 5 sectors will see earnings grow by more than 1%. Analysts expect that 3 of the 10 sectors in the S&P 500 will see earnings decline. Utilities by 16.2%, energy by 13.5%, and materials by 11.1%. This trend highlights the clear discrepancy between earnings and revenue growth that we discussed previously, and most companies are still facing higher commodity costs, which are eating up profits. Troy Alstead, Chief Financial Officer of Starbucks, reminded his listeners at a recent conference that his company, like many of his peers, has suffered from extreme commodity cost pressures. Though commodities have fallen off significantly recently, we need to recognize that. Today, with the end, but they haven't. The previous high prices are just rolling into the earnings now. Today, with the end of the second quarter, it's begun here today. The company, along with those same peers, must now also battle the macro challenges that we face in Europe, and that's a direct quote. I need to mention something here regarding distortions in hedging operations. Hedging corporate exposure to foreign currency is a tried and tested way for multinational companies to reduce the likelihood that their earnings will be dealt a blow by a sudden unfavorable move in the dollar exchange rate. While most companies don't disclose these hedging activities on their balance sheet, it is logical to assume that most have extensive forms of hedging strategies. So, with that as a background, let me talk about a couple examples here that I picked up on. Priceline.com, the online travel company, is more reliant on international gross bookings than it is on its U.S. revenues, and like many of its peers, reduced earnings guidance during its most recent conference call with investors and analysts in light of the challenging economic conditions in Europe. But what I heard was that Dan Finnegan, the chief financial officer, warned that expected volatility in the euro-dollar exchange rate can materially impact, and the quote was, can materially impact our results expressed in U.S. dollars. But, obviously in order to protect its sales, Priceline explained that it has contracts in place to shield a substantial portion of its second quarter EBITDA and net earnings from fluctuations in euro or pound against the dollar during the second quarter. But what is the exposure here if it is that significant? Well, then I read about Adobe Systems posted results that were slightly better than analysts had predicted. It announced earnings of 60 cents a share compared with Thomson Reuters' consensus forecast of 59 cents a share for its second quarter, which ended May 31st. However, the company saw $4.5 million decrease in revenue due to unfavorable currency rates over a year earlier levels. Mark Garrett, the chief financial officer at Adobe, told the conference call attendees that the company had a $10.7 million gain from hedging activities in the second quarter compared to a $200,000 gain from hedging during the second quarter of 2011, a year prior. Thus, the net year-over-year currency decrease to revenue, considering hedging gains, was $4 million. Hedging has been hiding revenue reductions. It may also cause further distortions or surprises when we see the real operating profits finally unmasked. It's getting really difficult now to see operating profits clearly in an international environment. When we consider various types of markets and the key risks at play within each, it is highly likely we have problems ahead. Clearly, this presentation or discussion is indicating that. But the wild card and major consideration is coordinated central bank intervention and how much of a short-lived lift it will actually give the markets. The markets are forward-looking, and they've already priced in a reasonable probability of central bank coordinated intervention. This chart from Decision Point, which is a mechanical thrust trend model for the S&P 500, has switched from neutral to buy. The signal was generated by the thrust component, which consists of the price momentum oscillator called a PMO here, and the percent buy index labeled PBI. Once both of these indicators have moved above their EMAs, exponential moving averages, a buy signal is generated. And you can see that the PMO crossover occurred earlier this month. The PBI crossover occurred last week, which was more delayed than is normally seen. Well, the TDM, as it's called, is intended for intermediate term timing. The thrust component of the model is really more short-term oriented, and its intended effect is an earlier entry than we would normally get from the trend component alone. This makes it vulnerable to a whipsaw. At this point, we will wait for the trend component to confirm the signal, which will happen when the 20 EMA crosses up through the 50 EMA. This will take a while because there's still a lot of separation between the two. The timing model is far from perfect, but it has proven to be a fairly reliable tool for identifying changes in trend. At this point, Decision Point's intermediate term market posture has changed, in fact, to bullish. I suspect this is reflecting, and I'm using it as an example, an increasing likelihood of the central bank's intervention due to slowing economic growth and the market starting to react to it, and because of the slowing numbers that we've been talking about. Though I don't see this as a buy on the rumor, sell on the news, I do suspect the rally will be relatively short-lived and fulfill some of our presidential year expectations, and I'm referring to if, in fact, the FOMC delivers with some form of quantitative easing in its August meeting. What I see is that the U.S. and global economy is on the verge or on the edge of a major accelerating slowdown without immediate coordinated central bank actions. Coordinated, and I have in central banks being plural here. This is not a fix, but a delaying tactic with a hope and a prayer that ignites something other than inflation fires. The chart suggests to us that we will have some sort of short-term weakness in the equity markets as earnings season unfolds and puts pressure on the Federal Reserve or gives them more cover. Then, as we approach the August FOMC meeting, the market will continue and likely rally and then continue to rally if the Fed does deliver at the August FOMC or signals and continue during the run-up to the election before finally exhausted rolls over and the secular bear market resumes. And we have some fractals here of patterns that I don't have time to get into. I will in the report that suggests this also ties into a pure technical analysis with whether we get a rolling top, a wolf wave, or a truncated fifth. Time will tell on that. But we should have still some more upside before we see the final top. Since May, the old adage of sell in May and go away has seemed appropriate. It may work out partially, but many may return from holidays prior to the August FOMC meeting. No matter what, earnings are going to be a real cold shower and a headwind to more quantitative easing. The key dates to watch are shown here in this table, and they will confirm or change some of the timings possibly. So watch them all closely as they unfold. I will continue to post these on the tipping point page as they unfold on a daily basis. In closing, I'd like to take a moment just as a reminder. Do not trade from any of these slides. The slides and this discussion are for educational and discussion purposes only. They are not trading or timing advice. In closing, let me thank you for listening, and until next month, I hope that 2012 will continue to be an outstanding investment year for all of us. Talk to you later.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.